No strategic Bitcoin reserve and no announcement to free Ross Ulbricht on day one of President Trump's second stint in the White House. Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today, January 20th, Donald J. Trump takes the White House for the second time, and we as Bitcoiners were waiting to hear if there was any news on Bitcoin, the industry, Ross Ulbricht, or anything to do with cryptocurrency whatsoever. Bitcoin fans were left without any news here on day one. We'll be watching, of course, the way that things pan out over the next few weeks to see if Trump keeps any of his campaign promises with specific regard to Bitcoin. Now, you guys at the Bitcoin Layer know how we've been thinking about the strategic Bitcoin reserve. Number one, we felt that a strategic Bitcoin reserve was not at the top of the list for what President Trump should be bringing to his Make America Great Again agenda here for his second term. But secondly, we've been very optimistic about one happening. Now, the reason that we believe a strategic Bitcoin reserve is coming is because as part of Trump's America First agenda, he's going to try things in his playbook. One of those things is the Bitcoin industry that is in a boom year starting in 2024 with the legalization of Bitcoin spot ETFs. Now, one of the things in President Trump's playbook is the energy industry, and we'll talk about that in a second and how it relates to Bitcoin. But what I will say here, despite not having any Bitcoin announcements on day one, the energy announcement is most relevant to Bitcoin and the technology industry. So I'll get into that here in a little bit. Now, what about Ross Ulbricht? I think that this is one of these issues that will not be forgotten here from Bitcoin owners and holders, participants in the industry. They will want to hold Donald Trump accountable for this campaign promise. And it is quite black and white here with regard to Ross. There is no middle ground. I think that there could be a gray area when it comes to the strategic Bitcoin reserve, even if the president makes moves toward a pro-Bitcoin agenda, but doesn't have a specific stockpile of Bitcoin. A bunch of gray areas could come with regard to Bitcoin, the strategic position of the government, but not Ross. That is one issue here that we want to see him follow through on his promise. The rumor is that it is within his first few weeks of plans, so we will have to keep watching. Now, on the strategic Bitcoin reserve, no announcement, nothing in the news today, nothing in the executive orders, but I will mention for a second what happened within the cryptocurrency industry here in the last 48, 72 hours with the release of these meme coins bearing the name of people from the Trump family. A couple things. Number one, this is clearly a money grab from people within the family because releasing these meme coins and them appreciating directly, the value will directly accrue to the owners of the coin, which I'm assuming are held by the Trump Liberty umbrella, which is held by members of the family. So something that honestly is quite obviously a money grab. I did read the fine print on the website, and it said that this meme coin itself, is whatever it described it, is not a security and it is not an investment. So there was somebody that asked me, is this Trump coin going to be in the strategic reserve? I don't think that that's the way to think about this. Think of it as if the family were to print up a bunch of t-shirts celebrating the inauguration and to sell those t-shirts to fans. This is like a digital t-shirt. It's almost what you can think of it here. And watching the price of these meme coins go crazy over the weekend was interesting, but honestly, it didn't really move the Bitcoin price around that much. We did see some price action, but Not that much, and Bitcoin right now is trading at about 102,000. This is right in the middle of its range for the last few days. Reading between the lines, though, I can give you my initial gut reaction, which is that releasing these coins between whoever the family members were that did this, they're front running action within crypto. And that's really what I believe. I think they know a strategic Bitcoin reserve or positive Bitcoin announcements are on the horizon. Those announcements will support all coins, Bitcoin and otherwise, and they're looking to make some money off of that. So I do look at the meme coins as a potential green light signal, but let's not make too much a deal out of them right now. As Bitcoin's role in the global financial landscape evolves, understanding its potential impact on your wealth becomes increasingly crucial. Whether we see a measured adoption or accelerated hyper-Bitcoinization, being prepared for various scenarios can make the difference between merely participating and truly optimizing your position. This is why Unchained developed the Bitcoin Calculator, a sophisticated modeling tool that helps you visualize and prepare for multiple Bitcoin futures. Beyond traditional retirement planning, it offers deep insight into how different adoption scenarios could transform your wealth trajectory. What sets this tool apart is that it's integrated with Unchained IRA, the only solution that combines the tax advantages of a retirement account with self-custody of Bitcoin. In any future state, maintaining control of your Bitcoin keys remains fundamental to your Bitcoin strategy. Explore your potential futures at unchained.com/TBL. Don't write your seed on paper. It's estimated that so much Bitcoin is lost forever, and the main culprit, the main reason, is poor seed phrase security. This is why we use Stamp Seed, a DIY kit that enables you to hammer your seed phrases into titanium plates using professional stamping tools. These plates are heat resistant up to 3,000 degrees, fireproof, crush-proof, and time-proof. They're compact and easy to hide, and they can be used in your single sig or multi-sig setups. Make sure you go check them out today at stampseed.com and use code TBL for 15% off of your order. Going to the price really quickly on Bitcoin, I see the support level right around that $100,000 level. If the 100K level supports, it makes the Bitcoin market even stronger. And I want to talk to you guys about path dependency here. We'll do that toward the end of the video. I'll give you my idea on why I think Bitcoin is heading to $150,000 and $200,000 in short order, and it does have to do with path dependency. All right, what was in the executive orders today? Let's talk about a couple of the issues. We don't need to make this show a very political one. It's the Bitcoin layer, so let's think about some of the announcements and how they will affect Bitcoin specifically. Now, the first one I want to talk about is the hiring freeze at the federal level. We saw a hiring freeze at the IRS, but also a federal government-wide hiring freeze. Now, I also want to talk about tariffs, so we'll do that right after the hiring freeze. But I'm thinking about the economy and inflation. When we think about how the European governments have faced trouble over the last year, I'm talking about France specifically, Canada, Trudeau on his way out, and Biden, of course, on his way out. These three political situations all have inflation in common, and while different countries have different political battles that are going on within them, the dissatisfaction from people with rising prices is not something that can be ignored. And the people go out and they vote out whoever was in power that oversaw that inflation. Now, when it comes to the hiring freeze, well, let's just say, thinking about the economy and what we want to see from the economy going forward, we think about inflation causing people to get voted out. So the people that get voted in, what will they want? They will want low inflation to make the voters happy. So it's my understanding and my expectation that Trump will enact policies that work to lower inflation on the aggregate. There might be policies that you think, hey, that's going to increase prices for me tomorrow. But my overall approach to this new term is that Trump will seek policies that work to diminish inflation. One of those policies is government deficits. So the larger the government deficit, the more stimulative that is to the economy, especially when banks buy T-bills and absorb that debt onto their balance sheet, expanding the size of the credit system. When the credit system expands, it gooses risk assets, the stock market, Bitcoin. That's why we watch the deficits. And I want to talk about my personal experience with global macroeconomic research for a second. Let's just pause my analysis on what's coming from Trump to talk about how I've thought about politics for my entire career. And I'll tell you, for the early years, I didn't want to pay attention to politics because as a global macroeconomic analyst, I'm trying to figure out if currency rates are going to move up or down, if the stock market is going to move up or down, or inflation. Those things are driven by trade, by the economy. I didn't see a difference between a Bush economy or an Obama economy. I just was watching the markets go up and down. As we saw more and more evidence of how much the fiscal side of the equation can impact the economy, I started to realize that maybe I'm not paying enough attention. A special shout out to Lynn Alden in the 2022 period of time, her pointing out that, hey, the inflation that's here is with us because of these deficits. Go look at the 40s. Go study what happened when we have these massive fiscal deficits and the credit system expands to account for those deficits. Then you look at the interest expense as a percentage of tax receipts and as a percentage of GDP, and you start to think that the size of the fiscal deficit, the size of the interest burden, all are going to affect the economy way more than we thought, especially when we are in a world of 36 trillion in debt and 3 trillion of tax receipts. Over 1 trillion is going right to interest. So this is a big deal. We want to think about the fiscal situation as much as possible because we know it affects the U.S. economy specifically. It also affects credit expansion. That's why it's so important, because at the Bitcoin layer, we try to relate everything that's going on in the markets to one metric, TBL liquidity, and then try to understand what's happening with stocks or Bitcoin because of TBL liquidity. Well, what does TBL liquidity include? It includes the banking balance sheet of the world, as well as interest rates and bond volatility and the price of the dollar relative to other currencies. So the first ingredient there, the size of the banking system. As it expands, it will boost risk assets. And why does the banking system expand? When credit providers lend money. One of the borrowers for that money is the government. And when the government issues a lot of treasuries and banks go to buy those treasuries and expand their balance sheet to do so, they are creating money. This is the monetization of debt at both the Fed and commercial banking level. Right now, the Fed is not engaged in active monetization of debt. It's rolling off treasuries from its balance sheet, but commercial banks are stepping in for those treasuries. And we also believe the Fed will be going back to balance sheet expansion by the end of this year. We were wrong about the Fed winding down the end of QT in 2024. It was something that we were expecting. It has still not happened. The reason that it has not happened simply is that reserves are not yet scarce enough. They are scarce because we've seen month-end repo disruptions in both September and December. So we are watching the Fed's action on their balance sheet. They have not indicated they're ready to stop QT and increase the size of their balance sheet again. That actually has us a little worried that they'll come into a problem instead of trying to get ahead of that problem. But we might be in a different situation than where we were in September 2019. We have new repo facilities that allow participants in the market to go out and seek emergency funding. Right now, I'm talking specifically about the standing repo facility. So on the top side of the Fed's corridor of policy rates, remember that the Fed funds rate is not the rate that they set. They actually set rates that are a ceiling and a floor above and below Fed funds, guiding rates in that direction with the zero arbitrage principle. So on the top end of their policy rates, we have the discount window, and we have the standing repo facility. Now, what's the discount window? The discount window is a facility. If a bank needs liquidity, if it needs funding, it can go to the Fed, pledge collateral, treasuries, and borrow funds at the discount window rate. That rate is supposed to be a defense against money market rates rising above the Fed's corridor, their desired policy window. But guess what happens with banks? They don't want to use the discount window because they are afraid that their neighbor will find out and stop lending them money. And by neighbor, I mean fellow bank. So there's a stigma, a negative stigma with the discount window. The negative stigma with the discount window definitely contributed to the 2019 repo crisis. So what did the Fed do? They put in an emergency repo facility called a standing repo facility. It's almost the same thing as the discount window. You pledge collateral and you borrow funds against that collateral through the repo market this time instead of through a window. Now, the standing repo facility is new. It didn't exist in 2019. It exists today. So the Fed might be cocky and think, oh, we have a repo facility now at the upper end. The repo facility would have prevented the September 2019 repo crisis. So the little issues that we're seeing September quarter end and December year end with repo rates, we're not so worried about it. And we think that the market will be okay. And if it's not, we have our own facility to make sure that we have the backstop to the market. Now, do I agree with the Fed on all of this? No, I don't. But we will have to see if reserves become scarce to the point where the Fed has to abruptly stop QT or not. Sorry for the little QT rant, but I was wrong in 2024 on when the balance sheet would stop contracting. So I want to hold myself accountable. I want you guys to also know that I'm holding myself accountable with my analysis, and we will be continuing to watch the Fed's balance sheet and see if they stop shrinking it and eventually expand. Now, why isn't the Fed's continued QT, why isn't that affecting risk markets and causing risk markets to come down? Well, that is a can of worms. We'll get a little bit into that right now. Now, the reason that we believe that we haven't seen a negative impact to risk markets from QT and the shrinking of the Fed's balance sheet is that there are too many liquidity mechanisms that are positive for liquidity relative to this Fed shrinking balance sheet, which is, of course, negative to liquidity. One of the main things that's positive to liquidity is banks increasing the size of their balance sheet. So even though the Fed is contracting, banks are expanding. Interest rates are stable to the point where we don't have bond volatility spiking and you get a ton of put buying, meaning insurance buying from the market. So those are the reasons that we believe the market is doing fine. And by market, I mean risk markets even though the Fed is shrinking its balance sheet. Now, one more thing on the hiring freeze here. Trump is trying to get policies into the government that reduce inflation. Hiring freeze will reduce the deficit. And remember, I'm just talking linearly here. I know there's a million things going on and a lot of moving parts, but in this analysis, you keep it linear just to isolate what's going to happen. The hiring freeze reduces the deficit, reduces inflation. So that's why he's going for the hiring freeze. One more thing he did, the national energy emergency, announcing more drilling in Alaska and other places around the country that we're going to use the gas and oil that we have, the highest amount of reserves anywhere in the world when it comes to fossil fuels. The energy emergency and having access to as much energy as we have as a country, what does that do to energy prices? It lowers them as you increase the supply. So if we are going into a world with a lot of energy demand, and we are, you need a lot of energy supply. And unless you have the supply, the demand will make the price go up. And if the price goes up, you have inflation everywhere because energy is an input to everything in the economy. So ample supply of energy will net reduce inflation. Whether that can happen in 30 days or 90 days, I don't think so. You can't just get prices down by increasing supply overnight for an industry that requires a ton of capital expenditure, drilling, exploration, pipelines, etc. We can't just create a brand new oil and gas infrastructure overnight to solve the energy problem, but Trump is trying to get the country on its way. So deflationary policies have to be in the mix if there are also other inflationary policies that are there. I'm thinking about tariffs. Now, don't just assume tariffs are inflationary. Tariffs will support domestic reshoring, which could increase prices, but then dual supply chains could reduce prices in the long term for consumers. So there are a couple sides to the tariff thing, and let's mention the dollar here. A strong dollar will cause energy prices to go down for Americans, commodity prices to go down for Americans. So a strong dollar could help calm inflation, but we heard Scott Bessent, the incoming Treasury Secretary, talk about how important it was to get a weak dollar to support the American export industry. So way too early to say on the official dollar policy from the Trump administration, but what I can tell you is that we will be watching the price. Of late, the dollar is up, and the dollar has been looking quite strong. A strong dollar, however, has not hit Bitcoin and stocks in the way that some might have expected. Stocks and Bitcoin still doing quite well, even though the dollar is up several percent since the election. I believe about 6% from the election. Let me just pull it up for you guys here. From about 100 to 108. So about 8% here since the end of September, and about 5% since the election. All right, I want to close with some thoughts about credit expansion and the way that I've thought about markets over the course of my career and how I'm thinking nowadays. In this world of credit system dominance, we live in a world in which the way that stocks go up forever is the expanding balance sheets of the system. And now when you're growing up and you're studying economics, you're studying markets, you're taught that a credit contraction can lead to a recession because when people stop borrowing, they stop spending and the economy slows down. Now, that is still 100% correct and the right way to think of it. But what how do we even get credit contractions these days? If you go and you look at a credit contraction, we can see one in the early months of 2023, resulting in a collapse of a few American banks. The collapse of those American banks immediately hit the SLOOS survey, which is the Senior Loan Officers Survey conducted by the Fed. And what did you see? Contraction, a lack of willingness to borrow. So shouldn't that credit contraction turn into a recession? It should, but it didn't. And the reason why is because when you have a credit contraction, you have an expansion from policymakers so quickly because they know how quickly a contraction can turn into a recession. And now we come back to the Fed's dual mandate. 2% or 3% inflation, it doesn't matter. What matters is that the mandate is expansion. The mandate is to avoid contraction at all costs. So as we get deeper into this too big to fail era, which by the way started 16 years ago, 17 years ago, we had too big to fail start. We're 17 years into too big to fail. And the time that policymakers allow for credit contraction is shrinking and shrinking and shrinking. Now, I want to invoke Michael Howell for a second because Howell has taught us a lot. We learn a lot from Michael Howell. One of the things we learn is that liquidity, the concept of liquidity, should be thought of as rollover risk. So you have 300 trillion in debt globally, and that 300 trillion, I think it's up to 350 trillion now, it rolls. It matures, and when it matures, you either can do two things. The credit system can contract, or the debt can roll and it can stay the same. That's it. Only two things can happen when a maturity is due. It either rolls or it matures. And if it rolls, you get new money created. And if it matures, you get a contraction. And so when Howell is looking for contractions, he's looking for the inability to roll the debt. For the bank to roll the debt for the consumer, for the customer, for the borrower. Every loan is a two-sided deal. It's a borrower and a credit provider. Well, if the borrower wants more money, but the credit provider doesn't have it, the system contracts. So how do we get recessions? How do we get stock market crashes? It's the lack of ability to roll the debt. But if the policymaker decides we are not going to let the system contract, do you ever get contraction? Do you ever get a decline in the stock market? The answer is yes, but it is for an increasingly shorter and shorter amount of time each time we go. Now, let's summarize this. Am I making some big claim that we'll never have recessions or credit contractions anymore? No, I'm not making that claim. But it is starting to inform the way that I'm looking at the system. Credit expands in a way that this whole natural contraction as a solution to overextension of credit is disappearing from every policymaker on the planet. And so there is a fear of recession that is so immense. Anytime there's a hint of credit contraction, there's a panic and there's a bailout. Now, my last point today is on path dependency. So what is path dependency? Path dependency means that while you might have a projection for the way I think things are going to pan out over the next 5 years, something 1 year from now could affect the path so as to change your projection entirely. And so in my projection, I believed Bitcoin would get to $1 million sometime in the next few decades when I entered this industry. Now, I believe that timeline is accelerated significantly because of path dependence and where we are today at $100,000 in Bitcoin on the precipice of potentially a pro-Bitcoin administration, a strategic Bitcoin reserve, and the accumulation of Bitcoin in strategic portfolios around the world, not just at the individual state level, at the national level, sovereign wealth level, state pension funds, and corporations. So looking at today where Bitcoin is at $100,000, before you get into that strategic FOMO race, tells me we're heading to 200. We're heading to this accumulation phase that kicks off an institutional FOMO phase, none of which we've even come close to entering. Now, TBL pros, they have access to a once a month Zoom Q&A that we do live. They're able to come there and ask me their questions and really get my unedited thoughts. And one thing I told the pros last month was that the indicator I use for an overheated market is not anything on chain or with momentum indicators, or I should say candlesticks, but candlesticks are always important and always dominate my analysis, but not momentum indicators, not on chain. The thing that I'm watching most to get a sense if we are in the bubble period is the text message indicator. Who is texting you about Bitcoin and why? Is it the people that are more interested in a get-rich-quick avenue? If it is, you know you are at the tail end of whatever Bitcoin run. And so when we hit $100,000 late last year, I can tell you the text message indicator with a big smile on my face was not ringing any alarm bells, meaning I didn't have any random people popping into my cell phone with, hey, is this a good time to buy Bitcoin? People that I haven't heard from in a couple years or might be, trying to chase some get rich quick sort of profit. The only people that reached out to me after Bitcoin crossed $100,000 were my family members who I love dearly and who love me as well. And I'm telling you this because the bubble phase of Bitcoin is nowhere to be found today here on January 20th, 2025. There is no bubble-like behavior in the Bitcoin market from my own qualitative, non-quantitative behavioral analysis. It just isn't there. And that is why, from a path dependency perspective, I see an easy double from here on Bitcoin. So I hope that you guys enjoyed this video today. A little wide-ranging, talking about the markets, politics, my own research journey as we've gone through the years. As I've gone from a trader to a writer to now just, trying to be a teacher for you guys and teach myself, learn myself at the same time. I'm a never-ending student here, always trying to stay humble and make sure that I'm not assuming that I have it all figured out. And I hope in that process, you guys will learn along with me too. Thanks for sticking with us once again at the Bitcoin Layer. Make sure you go to thebitcoinlayer.com/subscribe and sign up to become a TBL Pro. It is the best value out there, guys. We want to make sure that you guys have access to all of our research, our analysis, TBL liquidity are great metric that has over a 70% correlation with Bitcoin and the stock market. So check all of that out at thebitcoinlayer.com/subscribe, and we'll catch you guys next time.